That the National Stock Exchange is the world's largest derivative exchange by volume. And remember, this is when India's stock market value is around $3 trillion, while US stock market's value is around $40 trillion. So today we are going to learn about the very basic concepts of futures and options. These are together called derivative instruments in stock market. What is a future contract? Let's take an example. Ramu is a wheat farmer and Shamu is a bread maker. Now, a bread maker takes wheat or wheat flour as the raw material. Now, as you know, everything is controlled by supply and demand. The price of the wheat will be controlled based on supply of how much wheat is available and the demand for wheat. Now, Ramu seems to be worried. This is February month and Ramu's wheat is to be harvested in April, and that's when he can sell it. Why is Ramu worried? Well, he says last year he was able to sell the wheat for rupees 20 per kilogram. Now, with these all uncertainties, Ramu is worried if he can get a reasonable price this year. What if the price drops well below 20? What if it comes to 15, 14? That's why Ramu is worried. Now, Shamu is the baker. He seems to be worried too. Shamu wants to buy fresh wheat soon after the harvest in April. His stock of wheat flour is very less. Now, he's hearing some rumors that this year's harvest is not going to be so good, so there are chances that the wheat prices might go up to 25 rupees per kilogram. That's not profitable for Shamu. Now, what does Ramu and Shamu does? They enter into futures contract for April. According to this futures contract, Ramu can sell wheat at rupees 22 per kilogram to Shamu in April. Yeah, and this is acceptable for Shamu as well. Shamu can buy wheat at rupees 22 per kilogram from Ramu in April. What we just saw was a futures contract. The April month wheat future was just traded at 22 per kilogram. Ramu and Shamu both are free from their worries. They can make use of this futures contract to actually trade the actual quantity of wheat at a price of 22 per kilogram in April. This contract was agreed now. Similar to this example, in stock market we have futures available for stocks, indexes and commodities. Some examples are stocks like Reliance, TCS, indexes like Nifty. Futures are available for commodities like rubber, soya, gold. Now, in this example, even though this future contract was traded by real people like Ramu and Shamu, practically in stock market the futures are being traded mostly by large institutions, big players, domestic institutions, speculators, hedges, etc. Now let's look at some examples of stock futures or index futures in stock market. In the first table that you hear, I am displaying the Reliance Industries current stock price and the futures prices. Current stock price, as you see, is rupees 2110. And today it went up by 1.60%. And July month futures traded at 2116. Remember, this is at a premium to the current stock price. Similarly, you can look at August future price. It's even higher, 2124. And in September it's even higher, 2134. Not necessarily always the future prices will be more than the actual stock prices. It could be even less depending upon the market sentiment. Similarly, we can look at some index futures. We have futures available, Nifty indexes, Bank Nifty, and many other indexes. Today, the Nifty index was traded at or closed at 15,923. In fact, it was marginally closed in the red. And July Nifty index futures today were closed at 5938.75, marginally in the green. August Nifty futures were traded at 15978, marginally in the green. Now let's look at who actually trades in a stock or an index and how much. We can trade when we trade in a share. We can trade even as small as one share. That means the minimum unit that we can trade in a share is one share. But in future, there will be a minimum unit. There will be one lot, which could be 50 or 100 or 250, depending upon the stock or index's value. Let's see an example. Today, one Reliance share costs rupees 2,110. One lot Reliance July futures would cost around 250, being lot size, into 2116 is the future price. It costs around 5,29,000. However, theoretically, this is the cost you have to pay for July futures, but most brokers provide margin, so which means that the person who buys this need to pay only 1/10 of this total amount. Now what happens? 1% upside in the stock, that would mean mostly around 5,290 rupees profit in one lot future. Whereas in 1% upside in the Reliance share would give you only ₹21 profit. And then who trades in these futures? Hedgers. In our example, Ramu and Shamu both were hedgers. They wanted to hedge against a possible worry. They wanted to hedge against a worry that the wheat prices would fluctuate beyond their control. Typically, hedgers are manufacturers, producers. Now, speculators. These are large institutions, domestic institutions, and there are retail traders, high net worth individuals. They act as a middleman to trade in futures. They provide an important facility here. They provide liquidity to the future market. Now let's talk about options contract. There are two types of options contract: stock options and index options. Let's learn this through a real world example. Shamu, the bread maker, he's having another problem now. Shamu doesn't want to buy wheat right now. He wants to buy the wheat next month. Wheat is 21,000 per ton now. Shamu can't buy it because he doesn't have the money now. Neither does he have the place to store all those wheat now. But the problem or the worry for Shamu is that what if the price goes up to rupees 25,000 ton by then? Who can help Shamu? Another person comes to the picture, Leela. Leela says she can help Shamu. Leela says, I'll sell you a wheat call option contract of strike price 22,000. The cost of option contract is rupees 500 only. Sounds like a good deal. Well, call option means right to buy. Shamu is trying to use the option contract to buy wheat at rupees 22,000 per ton in June. This is a call option. Now, as we saw, Leela sells a call option to Shamu. Current wheat price is rupees 21,000. Now, Shamu buys one lot of June 2021 wheat 22,000 call option contract from Leela for rupees 500. As in futures, the lot size of call option may vary. Here it was, let's assume, it was 1000. The unit cost of this contract was half a rupee, and then since the lot size is 1000, that's how Shamu had to pay 500. Leela got 500 now. Now this contract expires on a monthly basis. These days weekly contracts are also available. Let's say this contract expires on 25th June. This means Shamu has a right to buy 1 ton wheat in June at rupees 22,000 per ton, no matter what the price of wheat at that point of time is. This contract costed rupees 500 to Shamu, which he has to pay to Leela. Now what happens in June? Let's assume in June 25th, market price of wheat went up to rupees 26,000. But Shamu can still buy wheat at rupees 22,000 by exercising his call option contract. Now value of his June 2021 wheat 22,000 call option will be determined based on how much above the strike price is the wheat trading at that point of time. So that means the value of this call option would have become 26,000, which is the current price, minus the strike price, which is 22,000. So the call option contract trades at rupees 4,000. Remember, Shamu paid only 500. Now in this case, Shamu gains and Leela loses. It's not, but practically this kind of scenario happens very rarely. Leela represents a class of trader called speculators. Now typically in such cases, mostly Leela doesn't lose. Now let's take another scenario. What happens? Let's assume if June 25th market price of wheat is less than 22,000 per ton. Now value of this call option which Shamu bought traded at zero. That's because the price of wheat at that point of time is less than 22,000. Shamu loses little bit. In fact, only 500 rupees, and Leela gets to keep her 500 rupees. But Shamu is still happy because Shamu's worries are solved. Shamu's main worry was that what if the wheat prices goes up to 25,000 or 26,000? That doesn't happen. Now, what if the wheat prices drop to, let's say, 18,000 per ton? Shamu is even happier because the call option value never falls less than zero. It stays zero no matter what in this case. But Shamu doesn't have to use that call option. Shamu can simply buy wheat at 18,000 per ton in that case. This is where call options come into picture in such cases. Now, one thing to remember is that there are call options at various strike prices. That will be different contract. Call option can be given around 23,000 strike prices or 24,000 strike prices, but the price of those call options will be even lesser at the time of contract because the probability of that level being reached is even lesser. In real world example, this is how call options can be used. Basics of call option is that when the price of the underlying stock goes up, the value of call options also goes up. The call options are available even for stocks like Reliance, TCS, Infosys, HCL Tech, and for indexes like Nifty, Bank Nifty, etc. The more the stock goes up, the call option price also goes up even more, and sometimes exponentially. One thing to note is that options is always a zero-sum game, unlike stock. That's because in case of stocks, when the stock goes into the upside mode, some people sells the stocks to some other people. Nobody loses here. The stock goes up because the company goes up. Company is growing. And when the company is growing, in fact, nobody loses. Everybody can potentially gain theoretically. However, in this example that we saw, Shamu had to pay rupees 500 to Leela. Either Leela loses or Shamu loses. Auction price at any given point of time is determined by various factors: time remaining for the contract to expire, volatility, interest rate prevailing, and the strike price for which the call option is selected. Now, who are the players who trades in options? Mainly, there are two categories: hedgers and speculators. Who are hedgers? Producers, wholesalers, retailers, or manufacturers. In this example, Shamu was part of a hedger who wants to hedge against irrational upside in wheat prices. And speculators, Leela was a hedger. Leela was a speculator in this case. Main speculators in the market are retail traders, foreign investors, domestic institutions, and proprietary traders. Though Shamu and Ramu are part of the hedgers who theoretically trades in options, practically in stock market, a majority of the trades are done by the speculators who wants to make money out of options. And people like Ramu and Shamu belongs to a very small percentage in the total trade. But there is a notion that the speculators are villains here. No, it's not like that. Speculators, they play an important role in the market. They provide liquidity. Now, what is the importance here? Here, let's say Leela was not there. For every option contract, there has to be for a seller also. For anybody to buy an option contract, somebody has to sell it. Now, who can possibly sell this? Ramu is not in the picture here. So, people like speculators, they are the one who sells this to pocket some of the money. In fact, they are providing liquidity to this market. If there are no sellers, Shamu can't buy this option. By use of this particular call option in this example, Shamu is free from his worry that he would have to buy wheat prices at a very high price in future. Now let's look at a real example of, we have the call options displayed here for Reliance Industries for July call option chart. I have highlighted in yellow the various strike prices. Currently, the Reliance Industries stock is trading at 2110. In fact, today's closing was 2110, and you can see the price of various call options encircled in green and orange here. So now you can see the 2120 strike price call option is closed at 38 points, and it is up by 10.75 rupees. And you can see there are call options for higher strike prices like 2140, 2160, 2180, 2200, but the price of those call options seems to be even lesser. That's because the probability that this particular level will be reached by the end of the contract is very less. As the strike price goes on increasing, the probability of that price being reached becomes less and less. In fact, we don't really expect Reliance Industries to go up, stock price to go up by 15-20% in 1 month. That's not really feasible. Today, Reliance stock was up by 1.3%. It closed at 2,110. Now, this particular 1.3% upside in the stock price would mean that anybody who bought the stock would have gained around 30 rupees once for in 30 rupees in one stock. If they bought 10 stock, they would have gained 300 rupees. Now what if the person had bought Reliance 2120 strike call options instead by the start of the day? Now by end of the day, the call option went up by 39% and it closed at rupees 38. And one lot would here for Reliance means 250 number of call options. This is the minimum units that you can trade. So overall cost of, if somebody had bought this call option 250 units on the previous day, it would have costed that person 6,812, and by end of today that would have become rupees 9,500. This would be around 39% profit in one day. Well, theoretically this is a very good trade opportunity, but this kind of opportunities happens very rarely in market. So typically people who sells the call options are the one who always gets the money in, I would say in 95% of the cases. But then who would possibly buy the call option? There are people who buy the call options out of genuine reasons, people like Sham. And there are even speculators or retail traders who genuinely buy call options to make money. And there are few people who make money as well. And that was supposed to call option. Now I will explain what is a put option. Let's use an example of Ramu the wheat farmer. Ramu has a new worry now. Last year Ramu sold wheat for rupees 21,000 per ton, and wheat is 21,000 per ton now, but the harvest is not done yet. It's a couple of months away. What if the price drops by that time to rupees 15,000? That will be heavy loss to Ramu. What can Ramu do? Now again, Leela appears here. Leela says she can help Ramu. Leela says, I'll sell your wheat put option contract for strike price 20,000. The cost of option contract is rupees 400 only. That means Ramu need to pay only 400 to Leela. Put option means right to sell. Right to sell a particular stock or a commodity at a future date at an agreed price. It could be 20,000 or it could be 21,000, it could be 22,000, or it could be 19,000, it could be 18,000. Depending upon the strike price, the price of that contract, the put option contract may vary. Here, Ramu selected the put option contract of 20,000 and the cost was only 400. Okay, so Ramu buys this put option from Leela. Ramu pays 400 to Leela. Current wheat price is rupees 21,000. What Ramu bought is one lot of June 2021 wheat 21,000 put option contract from Leela for 400. Let's say the lot size was 1000 and the unit cost was 40 paise, and hence Ramu had to pay 400 rupees to Leela. This contract expires on 25th June, beyond which this contract is not valid. This means Ramu has a right to sell 1 ton wheat in June at rupees 20,000 per ton, irrespective of how much low the market price of wheat is. This contract only costed rupees 400 to Ramu. Now what happens? Let's assume in June 25, market price of wheat went as low as rupees 14,000 per ton. Ramu can still sell wheat at rupees 20,000 per kilogram because he had selected this contract, put option contract. Now, by the time, the value of that put option contract will be determined based on how much lower than the strike price selected is that underlying commodity is trading in the market. So here, the contract was selected for 20,000 price. Now the market price is 14,000. Now the value of this put option contract became 6,000. Ramu gains and Leela loses. Sounds easy, but this kind of scenario happens very rarely. Leela belongs to a class of people called speculators. they would have done a lot of homework. Practically in 95% of the cases, this doesn't happen. Let's assume another scenario, which is a likely scenario. June 25th, market price of wheat is greater than 20,000 per ton. Value of this put option becomes zero. That because wheat is not trading below 21,000. Below 20,000. Ramu loses 400 rupees here and Leela gets to keep her rupees 400. But Ramu is still happy because his original worry was whether he can get to sell the wheat at a very good price or not. He accomplished that. Now, what if the wheat price is, let's say, rupees 22,000 in the market? Ramu is even happy. He can just simply ignore that particular put option because it costed only 400 rupees to him. Now, what we explained through this example was a put option. Here, when the price of underlying stock goes down, the value of put option goes up. More and more the stock goes down, put option prices goes up even more, and sometimes exponentially. And as I said, in the case of call options, options is always a zero-sum game. One person loses, one person gains. This is not the same case for stocks. And an option price is always determined by various factors at that point of time. Time remaining for the contract expiry date, volatility in the market due to various factors, interest rate prevailing, and the price of the strike selected. And there are two categories of people who trades in options, like in call options: hedgers, who are producers, wholesalers, retailers, or manufacturers. And here, Ramu comes under the hedger category because Ramu wanted to safeguard his interest of getting a reasonably good price for his wheat. And Leela falls under the speculators category. As I always said, speculators also played an important role in the market. They provide liquidity. Because remember, if Ramu wants to buy a put option, somebody has to sell it. And typically it's people like Leela sells it. I mean speculators. Let's look at the real example. I'm looking at the HCL Tech company's put option in the market, which today the HCL Tech stock was down 3.25% and it closed on 1006. The chart or table here shows the various strike prices put option and put option. The strike prices available are highlighted in red, and the value last traded price of today market closing is highlighted in the green and orange. You can say 1020 strike price put option today closed at rupees 37.55. It increased in value by 23 rupees. It was around 14 rupees yesterday. Because the HCL Tech stock went down by 3%, that's the reason why HCL Tech's put option went up. And this case it went up by 159%. And here in this scenario, HCL Tech one lot of put option means 700 units. So previous day, if somebody bought that 1020 put option, that person would have paid around rupees 10,150. And today, by the end of the market, because the stock prices fell, this put option would have become, the value of this put option become rupees 26,285. That's an amazing gain, but this kind of gain happens once in a blue moon. Practically in 95% of the cases, it's always option sellers, I mean the speculators like Leela, who always get to keep that money. This was about put option. That was about what I explained so far is a stock put option. Now let's look at These put options or call options are available for the indexes also, and this is the one of the most heavily traded derivative in National Stock Exchange. Look, this is basically the index option chain for Nifty. Here I have showed the call options as well as the put option for various strike prices. Now today the market closed at 15,923. So I would say let's look at the 15,950. Towards the left is call option, where I have highlighted. Towards the right is put option. So 15,950 call option today closed at 67 rupee. 15,950 put option today closed at 84 rupee. And as you can see, the strike price is decreasing, like 15,900, 800, 700. The value of put option decreases when the price is lower. And as you can see, 16,000 and 16,100 put options are even trading at a very high price. That's because the market is trading at a considerably lower level than this particular strike price selected. Let's say for example 16,100, the value of put option is 182 rupees. Currently the market is 15,923, almost 120 points below the strike price. Similarly, the call option, look at the call option. If you select the 15,800 call option, it's trading at 163 rupees. That's because the market is trading almost 123 points above the strike price of 15,800. Now, futures and options are together called as derivative instruments because the price of these contracts are derived from the underlying security or commodity or index. Do you know the volume of derivative market in India is 3 times as big as the volume of cash market? When I say cash market, the normal buying and selling in stocks. This indicates huge proportion of speculative trades compared to investing. Thank you for watching the video. If you like the video, please hit subscribe.